The stock market is currently closed today on Sunday, June 26, 2026. So we are looking at the final figures from the most recent active trading session on Thursday, June 18, 2026. Nebius Group NV, trading under the ticker symbol NBIS on the NASDAQ, finished that session at an exact closing price of $286.69 per share. This represents a solid intraday upward movement of 2.06%, climbing $5.78 from its previous close of $280.91. What should really catch your eye here is the trading volume. Over 36.6 million shares changed hands during that single session, which is an increase of more than 124% compared to its standard daily average volume of roughly 16.2 million shares. This is not just typical retail churn, it is massive institutional positioning that signals something much larger unfolding behind the scenes. While the broader market expects this company to be a highly volatile speculative vehicle left over from a complex corporate divorce, the underlying reality is far more compelling. Tomorrow morning, Monday, June 22, 2026, Nebius Group is officially being added to the NASDAQ 100 index. This is an incredible development that many casual participants completely overlooked until the announcement dropped. Membership in this index means that every passive fund, exchange-traded fund, and institutional portfolio manager that tracks the NASDAQ 100 is legally required to purchase millions of shares of this stock to match their benchmark allocations. This structural demand creates an immense buying tailwind that has pushed the stock up from a 52-week low of $43.89 all the way to its recent high of $298.80. Combined with an absolute mountain of cash on hand, totaling a massive $9.3 billion in reserves, the company is sitting on the kind of capital that allows it to build infrastructure at a speed that traditional tech firms can only dream of matching. If you scroll through popular investing sites or check your individual brokerage accounts on the Robinhood app, the prevailing public expectation is that this company is a risky, unproven newcomer. People assume it is just another speculative ticker that retail traders buy using Robinhood stock trading features or quick options on the Fidelity mobile app. The common ground among casual market observers is that Nebius is a dangerous play because of its complex background. However, if you look beneath that narrative, the reality completely challenges that cautious perspective. This enterprise has quietly assembled one of the most sophisticated, full-stack artificial intelligence computing platforms in Europe. They are not just buying hardware, they are integrating specialized performance stacks by closing major deals like their recent acquisition of EigenAI. They are actively positioning themselves to become a primary alternative to traditional cloud hyperscalers. When retail investors are looking for advice through online investing forums or seeking professional investment help, they are usually pointed towards massive, crowded options. But the smart capital is realizing that Nebius is running a completely different playbook, deploying capital directly into raw, high-performance compute capacity. Let us look closely at the intense price action we have witnessed over the last few trading blocks. The stock has been on an absolute tear, rising over 32% in the last month alone, and up an astonishing 227% over the last 6 months. This rapid appreciation is directly tied to heavy institutional accumulation. Large asset managers who handle massive wealth allocations do not just buy shares blindly on a standard Fidelity trading platform or an Interactive Brokers account. They look for massive liquidity events and structural changes. The volume spike to 36.6 million shares on Thursday shows that major funds were aggressively accumulating the stock ahead of the index inclusion deadline. This creates a supply squeeze because a significant portion of the float is now being locked up by long-term institutional holders. When you see this level of accumulation, it tells you that the smart money is betting heavily that the company's operational reality will continue to beat the market's conservative expectations. For anyone managing their own capital through self-investing strategies, whether you use the Robinhood app for flexible trading or a sophisticated Interactive Brokers platform for international execution, understanding this volume trend is critical. Sector momentum in the cloud compute space has been heavily concentrated in a few dominant names, leaving many searching for undervalued infrastructure players. As retail participants search for the best investing sites to find high-growth opportunities, they often overlook how back-end logistics drive these stock movements. Nebius is currently benefiting from an unprecedented supply and demand mismatch in raw computational capacity. Companies are waiting months, sometimes quarters, to get access to specialized clusters. Nebius has the cash to buy these chips immediately, giving them a massive operational advantage. This infrastructure build-out is already reflecting in their financial metrics, with revenues jumping significantly quarter over quarter, showing that their capacity is being monetized the moment it goes online. Comment below how many shares of Nebius Group you currently hold in your portfolio, or let me know if you are planning to add it to your watch list this week. To truly understand why the current reality is outperforming expectations, we have to look at what this business actually does and how it came to exist. Nebius Group NV is essentially the international clean slate successor of Yandex, which was often referred to as the Google of Russia. Following a massive, highly scrutinized corporate restructuring that concluded after years of negotiations, the Russian business assets were entirely divested and sold off to a consortium of domestic investors. This left the Dutch parent company completely free of any connections to its former home market, handed them billions of dollars in fresh cash, and left them with a world-class team of core technical engineers based out of Amsterdam. Instead of returning that cash to shareholders or winding down, the leadership team decided to pivot entirely into becoming a pure-play, high-performance AI cloud provider. They took their massive capital reserves and began purchasing thousands of advanced chips to construct massive data center clusters across Europe, including 3 newly deployed facilities in the United Kingdom. This business model is highly focused and efficient. Instead of trying to build a general-purpose cloud that handles basic web hosting, storage, and databases, they are solely focused on providing massive parallel computing power for large language models and complex algorithmic training. They buy the hardware, set up the specialized network architecture, and rent out the compute time to developers and enterprises globally. To solve the massive utility and power limitations that plague most data centers today, they recently partnered with Bloom Energy to deploy a 328-megawatt fuel cell project. This will allow their computing centers to run on clean, highly reliable power completely independent of local power grid constraints, which is one of the single biggest execution bottlenecks in the entire technology sector right now. This operational setup is why their revenue run rate has suddenly spiked, beating consensus estimates by significant margins in their latest quarterly reporting. When you look at this through the lens of a long-term investment strategy, the contrast between general market perception and corporate reality becomes even wider. Many people who manage their money through automated platforms like a Schwab Intelligent Portfolios account or a SoFi robo-advisor setup will completely miss an asset like this, because automated algorithms often flag young, restructured entities as too volatile or unseasoned. Even investors who prefer traditional individual brokerage accounts or stable assets like Fidelity Investments, Fidelity ETFs, or Fidelity Mutual Funds might hesitate because the company lacks a 20-year clean operating history. But for those engaged in active self-investing who utilize an interactive broker stock trading setup or a SoFi active investing account, the appeal lies in the massive divergence between the company's past corporate headache and its current financial powerhouse status. The company is trading at a high price-to-earnings multiple because the market is starting to price in the massive earnings per share growth that will occur as their new data centers hit full capacity later this year. Looking forward, there are several distinct paths this asset could take, and each one ties back to our core theme of expectation versus reality. The bullish path relies on the company successfully deploying their billions of dollars in cash to secure even more advanced chip allocations before their competitors can. If they can continue to bring massive clusters online ahead of schedule, their revenue growth will easily justify and likely exceed the current valuation. The inclusion in the NASDAQ 100 will also provide a permanent floor of institutional support, as passive index funds cannot sell their positions regardless of short-term market fluctuations. This institutional backing will change how the stock is viewed on major online investment networks, elevating it from a speculative trading vehicle to a legitimate long-term secular holding that sits alongside tech giants in modern individual brokerage portfolios. Conversely, the bearish path is rooted in execution and macro risks. If global capital expenditure into artificial intelligence starts to normalize or slow down, the rental rates for cloud compute could face significant downward pricing pressure. Additionally, relying heavily on a single chip supplier means any logistical delays or changes in allocations could stall their expansion plans indefinitely. There is also the risk that building out hundreds of megawatts of independent power capacity will run into local regulatory or environmental hurdles in European jurisdictions, which would delay their operational timelines and burn through cash without generating immediate returns. Investors using sophisticated investing sites, checking their Fidelity IRAs, or executing trades via specialized interactive brokers' fee structures must carefully weigh these infrastructure bottlenecks against the current hypergrowth trajectory. As we bring this analysis together, the central insight is clear. The market's old expectation of Nebius as a messy corporate shell is completely disconnected from the current reality of a highly capitalized, pure-play infrastructure leader. The massive volume we observed in the last session is a clear indicator that institutional wealth management teams are aggressively adjusting to this new reality ahead of the index rebalancing. While casual retail participants might view this as just another fast-moving ticker to play on a basic mobile app, the underlying fundamentals show a company with a clean balance sheet, zero legacy debt, and a massive war chest ready to capture the European enterprise market. Whether you handle your portfolio through a premium Fidelity brokerage account, track growth stocks like Tesla stock, Apple stock, or Nvidia stock, or manage active trades through SoFi Invest, keeping a close eye on how this infrastructure build-out matches up against future quarterly reports will be the key to navigating its valuation moving forward. The structural tailwinds are firmly in place, and as the market fully processes this transition, the gap between past assumptions and current execution will continue to drive the story of this asset. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Babs. Don't forget to like, comment, and share this video to support the channel.